Broadly, we are going to discuss what is money, what are the features of the money, how the banks work, and what is the role for Fed, that is Federal Reserve. Money interest, real GDP and the price levels, inflation, how things become expensive or de-expensive, fiscal policy, monetary policy. Policy made by the government is fiscal policy, policy made by the central bank is monetary policy. Section 6, money, the price level and the inflation. One system is the gold rate. Every country has gold versus they have the power for the money. The other is fixed rate, that is announced by IMF mostly, that this currency this much equivalents. And the third rate is a floating rate, which is demand and supply. Suppose in the end of the months, because people from UAE transfer the money to their countries, so the demand for dirhams goes down because everyone is transferring the money into their regional currencies. So it's stable, automatically stabilize its rates based on demand and supply forces. If there is no demand for any currency, so the value of that currency is low. But if more people are looking for dollars to pay and dollar is short in the market, so in terms of your local currency, the rate for dollar will go up automatically. So this is the third system which is nowadays. So if you have a money, you can store it as a basic component. How it affects, should we save the money in terms of the note? Surely we should not save the money, because you will pull out the money if you save it at your home, and it will affect the whole economic cycle, because it will take as a withdrawals and economic growth will stop. So money, you have to invest in the economy and you have to reshape it. Well, it depends how prudently you want to invest, but somehow every business has its own risk and returns. So the choice is with the investors. No one pushes the investor to spend in the real estate. It's the investor advisors or investor himself choose that high risk, high return. But these are, some risk attitude which we will discuss in corporate finance portion, that investor is of three types. One is risk averse, who don't want to take the risk. He always want to play secure. That's why he will go for a mature investment, which is slow and steady. There are some risk seekers. They avoid risk and they play big games, and big games has big results. Maybe it is a big success and it may be a big failure.
Big money.
So these are three major functions of the money. Two primary features in the US market is, we divide M into M's. One is M1 and M2. M1 is the most diluted form of the money. Diluted means that this is the real money that is which is contributing to the supply of money in the economy. For example, M1 includes all currency, but except not held at bank, because money in a bank is not going to increase the money supply. So M1 include all currency, traveler checks as well, and checking account deposit of individual and firms, but not government checking accounts. M2 is another form which is obviously have all the M1 inside, and plus time deposits, saving deposits, and the money market mutual funds, which will become part of the supply at a specific period of time. Now, what are the checking accounts? The deposits are counted as money, but the outstanding checks are not. And the check is simply an order to transfer the money from one bank to another bank. So it is not going to affect the supply of the money. It's just the movement of cash from one place to another place. Likewise, using a credit card does not increase the money supply because you have a credit period with it's like a facility to purchase without paying the amount. And same way, a credit transaction is a short-term loan where the card holder agrees to transfer the money to the card issuer when the bill comes due. So certainly once you swap your credit card, it's not going to inject money in the economy on the same time. No. It's an agreement, okay, once your bill will due, you will inject that time money as a circulation. So currently for a short term, it's credit card transactions generally considered as a short term loan. Same way, if you write a check to someone, you have money, it's like $100,000 in your account, which will shift from one account to another account. So being economists, we will not consider it as injections in the economic supply of money. Same way, if you have savings, you keep some money with you and one day you invest. When you save, this is called withdrawals. It's going out of the economy and money supply, you are shortening the money supply. But once you inject, it comes in the economy again as investments. So whenever we see economy, we see two things. One is injections, one is withdrawals. Withdrawals is savings. When you go for a saving, you withdraw from the economy. When you inject from that saving again in the economy, it gives the same economic revolution. So that's why always government try to inject in the economy. And this is we will discuss in detail in the later portions. Commercial banks and the institutions, money market funds all act as intermediaries in lending the funds of savers to the borrowers. This is the basic purpose of the financial institutions and the fund companies, to get the money from those who want to save and to give it the money to lend those who want to borrow the money. And this is the income cycle they earn. They take money on the fewer interest and they give on the higher interest. This is the advantage of the financial institutions, because if you divide financial institutions, there are some regulated, some non-regulated markets, some are private lenders, and there are some business angels, we call them. Whenever we need money, if our financials are not strong, we can go to some other private angel who can give us the money. But always he will charge the higher rates, because they are specialized, so they make a portfolio. 10% they invest in real estate, 5% in manufacturing, 10% in say hotel and leisure activities. You know, they have a portfolio. This is mainly whatever we can bring in the economy as economic growth. It all depends upon the central bank policies. Suppose 3 years before, why everyone was going to take the car, the personal loans and the financial loans, corporate loans? The reason is because the cost of borrowing was less. It was the least here in the region, all in comparison with all over the world. So everyone was taking loan, making business. They need resources. They were hiring people. So employment was increasing. More employment means more people are coming in the country. They have more demand, more consumptions. More consumption means more imports, more exports. So it was going to have the real economic revolution, which we saw also, and the things were going very fine. But opposite to this now, if you see, today the interest rates in comparison with 3 years before is much higher than 3 years before. And the policy for lending is very strict, means they are not friendly for the loanings easily. The asset of US Federal Reserve consists of treasury bills, notes and bonds. Almost 90% of the Fed assets are on that. Gold deposits with other central banks and special drawing rights at IMF. Now, in a fractional reserve banking system, a bank is only required to hold a fraction of the deposit in advance. The required reserve ratio is used to measure the reserve requirement. This is, we will discuss how money makes money, how one reserve create another reserve. Any excess reserves may be loaned. When a bank makes a loan, the borrower spends the money. And then the seller who received the cash may deposit into the bank. So this is money making money. This action creates additional loanable fund. Only a fractional amount of the deposit is required by law to be held in the reserve. This is referred to the multiplier effect. Now the same thing is going to tell us with an example. Assume that the required reserve ratio is 25%. And the bank itself need itself with $1,000 in excess reserves. Okay. So first time you will give this amount and 25% of this you have to keep in reserve. So in the economy it will be 750 will be injected. Now this 750 again these funds may be deposited into a third bank. And someone who takes 750 and deposit it into a new bank. Again, they have to keep 25% as the reserve ratio. So that's why I took this one. This amount will be again in the economy, multiplying the fact. And then again, this can be done. So if the lending and deposit continue, the money supply can be 1 divided by reserve ratio into the total amount. So $4,000 means $1,000 will be having a multiplier effect and generate $4,000 in a total economy. So this kind of multiplier are important to understand, and the central bank play with these multipliers. And $1 of excess reserve can generate a $4 increase in the money supply.